Hi, today I'm going to do a quick review of the last 3 months in the portfolios, what's been happening, what that means for all of our clients, and what we think is going to happen in the next few months, and how we're going to try and manage that for you. So April, May and June, they've seen a continuation in many ways of the trends that we saw earlier in the year. And at a headline level, all of our portfolios have just about stayed still. They've lost a very small amount of money, less than 1% to 0%. And we've very slightly underperformed the peer group, but at a level which is insignificant compared to the kind of moves that we've seen before we're targeting in the future. Now, within that sort of relative stability, there have been quite a lot of moving parts. So the US equity markets continue to do very well, as has Japan, where we have quite a large position. And the UK's been weak within equities. And actually in the bond market side, we've seen a little bit of pressure on bonds, especially in the UK with the UK gilt market. So all of that taken together, all the moves up and down in different assets, at a headline level, everything has actually been relatively stable. Now this is obfuscating really the big factor that's likely to happen in the next few months, which is whether or not we have a global recession, and a significant one. Now, if you looked at the videos I did in the last couple of months, where I talked about growth, the world choosing either growth or inflation reduction, I think given where we're at today, it is veering towards where the world is actually choosing inflation reduction, because I think, and we think, that the next move is likely to be quite a significant global recession, and I will try and explain why now. So if we looked at all the leading indicators that we think you can rely on, a lot of them are flashing red. So I'll start with the bond yield curve, so the market interest rates that are priced into bonds today, looking out into the future. So normally, near-term interest rates are lower than high-term interest rates, long-term interest rates, and that's called an upward sloping yield curve. Today, it's the other way around. Near-term interest rates are higher than long-term interest rates. This is called an inverted yield curve. Now, every time in history there's been an inverted yield curve, there has always, without fail, been a recession. And we don't think there's anything about today which means that we're likely to break that record, especially as other leading indicators are also flashing danger. So manufacturing leading indicators, services leading indicators. So all of the things that you look at to say, well, what's likely to happen in the future, they're all telling us to be concerned. Now, the thing that is holding up the economies is a relatively strong service sector today and very strong employment. So high levels of employment and high wage growth. Now, those factors are actually traditionally more like lagging factors that will change after the economy changes. So we don't get really much comfort from that. The market in general, in our view, is pricing in quite a soft landing. So they're expecting profits to be quite stable and strong in the equity markets, which is why the markets are quite strong. And they're expecting interest rates to stay quite high for quite a long time, which means that the bond market has been under some pressure. Now, if you remember a video I did a few months ago, if you saw it, I did talk about a natural rate of interest rates that I think a country like the UK can cope with. Well, we've actually reached that rate already. And we would expect in the next few months, as the impact of interest rates is felt in the economy, which has always lagged, that we'd start to see pain and pressure on consumer spending, and sort of negative feedback loops start emerging, the classic start of a normal recession. Some of you might be experiencing that already with your own mortgage payments who are listening to this. So our analysis hasn't changed over the last year or so, and we do expect that the effect of the interest rate rises we've seen will be lagged, and we're going to start seeing the effects, and we do expect there to be a recession. So we're positioned relatively defensively in our portfolios. So we are quite underweight the sort of higher risk equity markets like the US, and relatively overweight the bond market, especially with sovereign bonds like gilts. And what we expect to happen is that as the economy weakens and inflation declines quite rapidly, we'll see a rally in things like the gilt market and pressure on things like the US equity market. As always, if we're right, we'll try and use those changes to then shuffle around the positions within the portfolio to try and lock in higher returns in the next phase. But from us, in terms of our analysis, things are very much progressing to plan, is what I would say, and we feel that we have a good handle on what's going on. As always, if you're listening to this and you have any questions, please don't hesitate to get in contact with me. I'll be happy to talk to you or answer any queries by email. And I also must remind you, I have been talking about investments and your capital is at risk. Thank you.